Assalamualaikum and a good day to everyone. So today we'll learn introduction to qualitative characteristic of useful financial information and other accounting assumption and concept. Chapter 2 in your syllabus. So the objective of this chapter is explain the qualitative characters of useful financial information and other accounting assumption and concepts. Okay, so the content would be as shown. First is the fundamental qualitative characteristics which include relevance and faithful representations. Second is enhancing qualitative characteristics which have 4: comparability, variability, timeliness, and understanding. Lastly is accounting assumption and concept. Going concern, historical cost, economic entity, and money measurement. Okay, so let's begin. Okay, so conceptual framework. A structured system of interrelated objective, fundamental characteristic concept that leads to the development of high quality and consistent reporting standards. Provide foundation for financial reporting and identifies the objective of preparing the financial statement. The objective is to provide the financial information which is useful to both current and potential providers of resource in decision making. So conceptual framework is in simple is like a rule or standards that the report follow so that high quality and consistent report is produced and the information gained is useful for users for in decision making. Okay, let's move on. So the fundamental qualitative characteristics divided into two, which are relevance and faithful representation. So relevant means it is relevant if it would potentially affect, influence, or make a difference in users' decision. So relevant information must have predictive and confirmatory value. So relevant is when the information itself affects the user's decision. That's what it means by relevance. So the information itself must be predictive, which the users can use the information to predict what the business might be, and confirmatory value. You can confirm it, at least very confirmative value with the information received. Okay, faithful representation. The information that represent on economic phenomenon such as transaction or past event. It should ideally be complete, natural, and free from error. So for faithful representation, the information from the report represent the business correctly with complete, it means detailed information. Neutral meaning transparent, no fraud, no hiding any information, and free from errors, no mistake. So that's what it means by faithful representation. You can have faith in the information that is represented. Understand? Okay, moving on to the next slide. Okay, now is enhancing qualitative characteristic, which they have 4. First is comparability. Users are able to compare similar companies in the same industry to make comparison of their performance. So the users can compare a company within the same industry and see which have better performance. When you compare company A, company B, which is in the same industry, we will see which will have better performance, better profit, and you can make a decision where to invest. So that is what needed in a report. Second is variability. A company's accounting results are verifiable when they're reproducible given the same data and assumption. An independent accountant can produce the same result that the company did. Verifiability helps ensure the information faithfully represent the economic phenomena in report to represent. Okay, so variability in simple is when the data is given to an independent or outside accountant, the accountant still is able to produce the same report, the same result, which means it can be verified that the report itself is represent the business transaction, the business event in the year. So the report must be variability. For the third one is timeliness. The timeliness of accounting information refers to the provision of information to users quickly enough for them to take action. Information becomes obsolete and useless if it is not reported within time. So timeliness is that you must report the event happened quickly so that the information happens in that time is useful rather than obsolete, useless. The information reported must be present, must be reflective of the event so that the users can make decision making, can make decision. Okay, lastly is understandability, a principle which states that a company's financial information should be represented in such a way that a person with reasonable knowledge of business and finance and the willingness to study the information should be able to comprehend. So understandability is when users with knowledge of business or finance or any basic accounting knowledge is able to understand the report. So the report must be able to make the users understand the information given. So these are the 4 characteristics needed in a financial report. Next. Okay, now we go into accounting assumption and concept. Okay, it is a basic standard or guidelines in the conceptual framework. So you only learn 4 assumption and concept for this semester. First being going concern. Second is historical cost. Third is accounting entities or business entity or economic entity. They are the same. They have many names. It is the same concept. Fourth is monetary or money measurement. Let's begin with going concern. A business will continue to operate in the foreseeable future using its asset to carry on its operation and not offering the asset for sale except stocks. The business enterprise will have a long life and that it will last long enough to fulfill its objective and commitments. So going concern concept is the assumption that the business will run for a long time, non-stop, able to achieve its objective and commitment. As the picture stated, future, it is able to operate in a long time in the future, foreseeable future. That is the hint here, foreseeable future. Going concern is we assume the company will not go bankrupt in the near time. Okay. So next is historical cost. Historical cost principles state that business must record and account for most asset and liability at their purchase or acquisition price. Measuring this concept is simple and cheap. Historical concept means that when you bought an asset or make a debt on a certain period, you record it based on that period. Meaning, if you bought a car with a 10K cost, you record this 10K in the financial statement. Even though after you buy it in 2012, even in 2020, it is still 10K. That is what is meant by historical cost, recorded at the purchase price or acquisition price. Okay. Next is accounting or business or economic entity. It has so much names. Assume that a business is separate and distinct from its owner. Owner meaning shareholders or partners, anyone that contribute to the capital. Okay, so this one is accounting, business or economic entity. It has so much names. Assume that a business is separate and distinct from its owner, which is the shareholders, the one that contribute capital to the business. The items recorded in business book reports, this book is reports, are limited to transactions affecting the business only. The records and report of a business should not include either the transaction asset of other business or the personal asset and transaction of its owner. So this assumption states that you must separate the owner with the business. Okay, you must never record any assets by the owner in the business reports, and the business asset only stays in the business, never reported in the same report. Separated, that's what the assumption means. Lastly is monetary or money measurement. A business should only record an accounting transaction if it can be expressed in terms of money. This means the focus of accounting transaction is quantitative information rather than qualitative information. The purchasing power of the unit of RM used in account, the purchasing power of the unit of measurement used in accounting, the RM does not change. So this assumption states any transaction that can be recorded in terms of money will be put in the report. Only the transaction that can be reported in terms of money. And for Malaysia, our terms would be RM. Any transaction in RM, any that can change into RM will be reported in the financial statement. Okay. So that is all. The end. Thank you. Please ask any question if help is needed.